I'm hearing from a lot of folks in this alternative space that they can be that in a way that the public markets can't. Why?
Yeah, I think, Romaine, when you think back to what happened last year, the notion of diversification that our clients experienced and so well for many decades, bonds, equities, working in tandem, and actually building resilience in our clients' portfolios, stopped working. Mid last year, equity markets down 26%, and fixed income down double digits as well. So the notion that this resilience existed actually was really challenged. And I think what we've noticed today as we've talked to many of our clients, we actually did a survey at the start of the year just to get a sense of where they are with regard to private markets. What's their sense of investing? 24% of their allocation today in their total portfolios in private markets. And the reason it's there is because the things they cited that equities and fixed income started to lack, which is the resilience and diversification, but also the yield and income, these are now going to be providers of that balance.
So I was looking at that survey, and I thought it was interesting, the allocations to private credit, it was something like 70-something%, or private equity, 70-something%. Plans to increase in private credit was over 50%. That survey, though, was through January, before we had the latest regional banking crisis. Do you think that the next survey that BlackRock comes out with will show any material deterioration in that sentiment?
Actually, if anything, it'll show an increase, I think, in positive sentiment towards some of these asset classes. To go back to a bit of a banking crisis we're going through right now, the liquidity that's being taken away from the system that's allowing us to have various experiences on behalf of our clients, it's fundamentally changing. So as an asset manager, for example, in private credit, today with, I guess, Preqin estimates about $400 billion in dry powder, being able to put that to work to support these middle-sized companies in the US and across the world, I think the yields and also the diversification is actually quite strong.
I'm curious about the competition in this space, particularly private credit. Obviously, you work for an 800-pound gorilla, but you look around this room, particularly compared to past years, there's a lot more folks in this private credit space fighting for the same clients, fighting over the same assets, fighting over the same investments.
No, it's right. I think that today's estimation is, 38,000 alternative asset managers. But I do think, going back to the survey, that was 15 trillion of investable capital we surveyed. 200 clients across 22 geographies. The two things that they said that they were demonstrably underweight: private credit, infrastructure, equity. So as I think of the maturation of their portfolios, it's still underweight relative to what we would think it should be. And independent of the competition, I would say always buyer beware. There's always assets that go up and down. But nonetheless, I do think it's very immature, relatively speaking, as an asset class. So more to come.
When we talk about the difference between private credit and private equity, there's been some concerns that what investors are asking for right now is sort of more exposure to private credit, but at the expense of private equity. Are you seeing that?
Listen, we're still seeing demand for private equity. I just feel the valuations are still high. Like, we've seen a repricing on the smaller end, and venture and growth equity has repriced. At the larger end, you haven't. You're also seeing the activity. So IPO market, as you've even talked about today, is shut. In most cases, so the exits for private equity right now are hard, but there's a very interesting and buoyant secondary market. If you go back to some of the attributes our clients are looking for, that yield, that income, private credit is a floating rate instrument. And you have a huge universe of suitors who want that capital to help their business grow. So I think as a replicate, basically you can take private credit at a different risk profile, slightly shorter in duration, and lean into a space that provides great income, good diversification, but again, it'll require a tremendous amount of high quality underwriting as you think about the right price, the right structure at the right time, even in private credit.
I think there's room for everybody here. I do want to end on a broader question about macro conditions, the expectations potentially for a recession this year, and expectations about what the Fed's going to do. What's your base case right now when it comes to economic conditions?
Yeah, listen, we think we're in a very different investing regime. We're cautious, our clients are cautious. And I think at times like this, even if you think about the asset classes as we talked about earlier today, with the actions of the Fed really where they are today, they're driving us towards a recession. But when you look at the quality and the health of the consumer's balance sheet, corporate balance sheets, our hope is that that would not be deep, it would not be prolonged. So I think we have a sense of cautious optimism for the year ahead. from an investing standpoint, but from an opportunity standpoint too.